introduce yourself. I always love to obviously know your name, but where you're tuning in from as well, where you're watching from, so your location, and then if it's social media handles and LinkedIn, it's always is really great to kind of connect on this event and then off as well. So do jump in that chat with your name, location, and then social media handles and LinkedIn's. I can see Ben already jumping in. Thank you so much, Ben. Let's get it started. And just to note as well, in the chat, it'll say 2 panelists, and just kind of drop that down to say panelists and attendees. So everyone then in the chat will be able to kind of connect and see where you're from. So I see a whole bunch of humans from Earth. Amazing. Yes. Melbourne, Sydney, incredible. I don't want to waste too much time. Do keep that going. That's awesome. And let me introduce myself. So I'm John, and I'm the partnerships lead at General Assembly, which means I reach out to incredible brands and speakers such as Ben from Pivot to help me deliver these community events. So if you're joining us for the first time and don't know much about General Assembly and who we are and what we do, we're a tech education company offering high-demand skills in tech, and this is through our full-time and part-time courses, plus the workshops, and then these free events as well, where our mission is to empower those to pursue a career they love and help them with their career transitions into skills such as UX design, data science, and software engineering. That's it. If you do have any questions regarding General Assembly, do feel free to reach out to our incredible frontline team at oznz@geely.co. I've just popped their email in the chat there. They'll be happy to answer any questions that you've got. If you do have any questions during the session, please do pop them in that Q&A box, and then we'll hopefully get towards them like 10 to 15 minutes. Ben's going to go through them and answer those questions there. So do direct them to that Q&A box as well. We're recording the session. We'll be sure to send that out hopefully by end of week, so tomorrow, before everyone breaks for their Easter. And then lastly, before we get started, General Assembly Australia would like to acknowledge Aboriginal and Torres Strait Islander people as the first Australians and traditional custodians of the land where we live, learn and work, paying our respects to elders past, present and emerging. Thank you so much, everyone. Keep that engagement going in the chat. I'm going to pass it straight over to Ben to kick things off. So take it away.
Great. Thanks for that, John. And yes, guys, before you ask, yes, we did coordinate on our wardrobes today. My name is Ben Nash. I'm a financial advisor, and I help people with things like buying property in the smart way. Today, we'll be talking about all about buying property in post-COVID environment. Property market is crazy hot at the moment in different pockets around the country. Our capital cities, we're seeing in Sydney, I know that we're seeing some staggering property growth. So I'm going to talk a bit about the property market generally, but also about what we should be thinking about if you're looking at buying property today. Firstly, shout out to General Assembly for hosting the events. If you're not around what they do already, they do some great stuff. So check out their courses, and Raise Home Ownership, who have kindly partnered for this event. Also, they're sort of shaking up the mortgage market. So for people in that that are looking for that sort of support, do check them out. Guys, before I get into the content, for any lawyers there, please don't rush out and make any life-changing decisions off the back of what we cover today. I would strongly encourage you to seek out advice before jumping in. With property, it's such a big decision that you really should be doing that anyway. So make sure you get your strategy right. It's going to pay massive dividends over time. So I'm actually I was just doing a bit of research when putting together the presentation for today, and I thought a good place to start, excuse me, a good place to start was around the past, the historical property growth that we've seen. And I found some CoreLogic data that showed basically the median house price in Sydney from 1993, which they actually put this report out at 2018, which is 25 years between those two. So 94,000 back in 93. 2018, we saw 445,000. And we've seen some pretty staggering growth since then. In the last 3 years, since 2018, we've seen the median property price today in Sydney is $1,023,000. And then you'll see that I've got 2031 and 2041 there, which is all I've done is extrapolated out the growth rate of 6.8%, which you can see here, which is basically like the the 100-year return on Australian property to say what will the average median house price be 10 years from now and 20 years from now. So you can see that it's expected to pretty much double in the next 10 years and then almost to double again. And I didn't have the stats right in front of me, but I've gone back 6 decades and the numbers actually are exactly the same. So there's nothing for me. And while I don't think the growth that we've seen between 2018 and 2021 can continue indefinitely, but there's nothing to suggest that the long-term growth rates on property will change over time. And that's why, if you're buying property or if you're if you're looking at buying property either to live in or as an investment, the sooner you get in, the sooner you can start getting those results. And on the flip side, the longer you wait, the more difficult it is going to be to actually get into the market. So today I'm going to help you understand some of the strategies and tactics you can use to make your next step on the property ladder an easier one. Now, look, there's, the world has obviously changed with COVID. We've seen a record low interest rates, I think like 1.8% or something at the moment, which is pretty staggering and certainly never seen before levels. We don't know exactly what the world's going to look like in the next little bit with all the COVID pandemic and what that actually means. The property market has definitely been disrupted, and we're seeing, people moving out of the regions, a lot of companies having work from home first policies, and it's caused some structural change to, how people buy property, where people buy property, and how much people pay for property as well. The government is splashing a lot of cash around, although that's thankfully winding back, although, likely to continue for some time into the future as well. But look, while some things have changed, there are a lot of things that still the same. People still want and need money to be able to live the lifestyle that they want. Smart companies are still making good money. We're seeing the economy is actually surprisingly doing pretty well. Definitely in Australia, unemployment rates are low. Tech companies are going ballistic because of everyone's reliance on technology now, which is driving a lot of, for a lot of people, anyone that works for a tech company, your stock options and share plans are getting more and more lucrative. And that creates opportunity, and it creates disruption. And the last one here is that people still want to live at Bondi. And I use the word Bondi because it's iconic, but people still want to live in desirable suburbs, the inner ring of properties around Sydney, Melbourne, Brisbane, Perth, as well as some of the more, regional places. Like I think half of Sydney wants to buy a place in Byron Bay at the moment because everyone's been there on holidays while we've been on state-based lockdowns. So while there is going to be this new normal, I think it's going to be pretty normal. And I think when we think long term about this as well, that there's not going to be a lot of long term change to the property market or our desire to live in good areas and own property ultimately. So we'll talk a bit more about how you can take advantage there. But before I crack into the straight property, the property tactics, I just want to flag that, while everyone's situation is unique, that there are some really common challenges that people face when it comes to money. This applies to property specifically, but also to your money more broadly. Now, what we're seeing, because we're in this information age, that we've got this information overload, that there's just so much noise out there when it comes to your money, property strategies as well, that it's almost like we're drinking from the fire hose, and it's sort of like it's hard to know who to listen to, who to trust. Specifically in when it comes to property, that there are a lot of hidden agendas, conflicts of interest, and it can be a bit of a minefield. The second one is finding balance. And so I was just talking to one of the guys in our team just before about, we see people that are making really good incomes, and you want to have a good lifestyle, but you need to find the right balance for getting ahead with money at the rate that you want while you're able to actually live the lifestyle that you want. And finding that balance is different for everybody, but it is really the key to financial success. So, but people struggle to find that balance because it's not easy. The third one that I've got here is the FOMO, which everybody knows, the fear of missing out. I think that's driving a bit of property decisions at the moment. And then FOFU, which is the fear of fucking it up, basically. So you don't want to do the wrong thing. And especially with property, it causes a lot of paralysis that you don't want to do something dumb that's going to end up costing you a whole bunch of money over time and mean that you don't get the results that you want. So what that leads us to is to get stuck. And it's not always stuck doing nothing. Sometimes just stuck doing the same thing that you've been doing in the past and therefore missing the opportunity to be getting results, to be building your momentum. So there are 3 elements that you need to get right when it comes to buying property and to your money more broadly. The first one here is structure, which is all about making it easy to save and manage your money and making it really clear what money you have to work with when it comes to strategies like buying property or investing, paying down debt, whatever the case may be. The next one that we've got there is strategy, which is about, being clear on what's important to you, really understanding the different pathways that you can take to get you from where you are right now today to exactly where you want to be with your money. And then the third one here is solutions and making sure that you've got the right investments and product solutions to back up your strategy and give you that reliable, consistent progress over time. And importantly, avoiding the chances of downsides and setbacks and those momentum killing mistakes. So, today we're talking specifically about property and property strategy and tactics, but be aware that if any one of those areas is missing from what you do, it's going to end up dragging the others down. You might have a great property strategy and a great property investment, but if you don't have a good structure, you don't know how much you've got to work with when it comes to buying property or how much you should be allocating, how much you should borrow, etc. If you're good at saving and a good strategy, but you choose a bum property like bad solutions, then that's going to be a major problem as well. And a good structure and a good at saving, great property, but with a poor strategy means that you can, pay more tax than you need. You sort of end up costing yourself money over time. So the power of those 3 elements together is much more than any one of them alone. And as I say, you really do need to get all 3 of them right to get to real financial success. So, look, what we've found is that there are different stages that people go through with their money, essentially ranging from really bad to really good. And the things that actually typify, I suppose, which of the stages people are in is how quickly you're getting ahead with your money, what's your ability to live the lifestyle that you want, and how you're feeling about your money, your peace of mind, confidence level, stress level. So starting at the distress stage, and it is a progression that you can move through the stages. I'll give you some tips on how you can do that based on where you're at in a sec. But for people in this distress state, that's when they're making no financial progress at all, or sometimes even going a bit backwards. From a lifestyle point of view, they're essentially trapped because they've got no money to do the lifestyle or personal choices that they want. And then from a peace of mind point of view, obviously they're stressed out. I found that you can't actually get out of this distress state without making a commitment to your money. Money is one of these things that it is really important, but it's also not really urgent. So it's easy to let your money, put it on the back burner for the tomorrow that never comes. So if you end up in the distress stage though, you need to make a commitment to being financially successful. And without that commitment, it's definitely not going to happen on its own. The next stage up is the stalled stage, and this is a pretty common one. It's where people are making some financial progress, but it's slow and slower than they would ideally like it to be. That you're able to do some of the personal or lifestyle things that you want, but it typically comes at the sacrifice of getting ahead at the rate that you want. And then from a peace of mind point of view, you're not fully stressed out like people in the distress stage, but you've got that sort of niggling thought in the back of your mind that there's something that you're missing out on that could be, getting better results. The next stage is we see people in the comfortable stage, and that's where now from a financial perspective, you're starting to build some real momentum. You're finding a good balance between getting ahead with your money and living the lifestyle that you want. And from a peace of mind point of view, you're building a real confidence. The fourth stage is what I've very technically called the killing it stage. And for people in the killing it stage, that's when you're making really rapid acceleration now, basically no limits on the personal or lifestyle choices that you can make. And from a peace of mind point of view, you're feeling completely carefree. So guys, it is a progression, and there are some key things to do to progress through those stages. The first one I've got there is making that commitment. To get from the stalled to the comfortable stage, you need to take action, but take action on an ongoing basis. And because there's no such thing as a set and forget money strategy these days. You need that, because the world's changing so quickly. COVID is a perfect example that you need to do stuff now, but also to do it, to keep doing things in the future so that you continue to take advantage of the opportunities that are in front of you and course correct where needed so that you can get the best results. Then to get into the killing it stage, that's where you need to maximize every opportunity that's available to you to squeeze every bit of juice out of your situation so you build your money momentum in the fastest way possible. For you guys watching along, I would love it if anyone can identify with any of the stages. You don't have to say which one, but if that sort of resonates with you, would love for you to just pop it in the chat box and let us know. As I say, it is a progression to get through, and it's not always clear, but today I'm going to give you some of the hacks and tactics that you can do to get through that those stages faster. Haminda says stalled. Yes, and Damien says he's between stalled and comfortable. I find that sometimes we can be in some parts of our money, feeling like we're stalled, and then in other parts feeling like we're more comfortable. So Dee says finally uncomfortable. Well done. It's a good feeling. I think going through each of the stages is a big like a relief or an achievement as well. So there are some things that you can do to make your life faster, and that's what we're going to cover today. So property basics and the things that you need to know. Look, the first thing that I've got here is I just want to talk about the difference in shares versus property, and the advantages and disadvantages of each. Now, what I've done just to make the maths really easy and simple to follow along with, I've looked at a return on property of 5% and a return on shares of 5%. So basically the same. Now, you saw from that previous example that I gave you that really the long-term return on property is closer to that. Well, it is 6.8%. The long-term return on shares is around 8.7% or 8.8%, depending on whether it's an Australian or international. Now, but what I've done here is I've been really conservative with each of those, and I have I've extrapolated out what the property market, what the return on those investments would be. So basically you buy a $500,000 property, and if it grows at 5%, after the first year, your property is going to be worth about $525,000. If you had $100,000 and invested into shares, that your money would be worth about $105,000 at the end of that 1 year period. Then I've extrapolated out for the rest of the 10-year period. You can see that after 10 years, the property's worth $814,000. Shares is worth $110,000. And then if we keep going, after 20 years, you see property's now 1.3 mil. These are getting closer to the numbers that I was looking at before. And shares are the gap between shares and property is widening. And the reason that I show this is because when you're buying property, most people are borrowing. They're very rarely getting $500,000 and buying a $100,000 property. They're getting up like $100,000 and then borrowing some money from the bank, and then they've got this bigger asset that's working. You got this bigger asset working for you. So you could see in this example that if you were to use that $100,000 to get into a $500,000 property, it's very difficult for even a really good share portfolio to compete because it's starting from a much lower base. So the leverage is the key driver of property returns. If you look at like property versus shares, the returns are pretty much the same, but when you introduce the borrowing element, it means that it means that you basically leverage and amplify the returns that you get. So look, it's not there are things like interest costs to consider, growth rates, and all of these things, but you can see from these numbers that there is so much room between the two of them that there's plenty of room to cover those sorts of incidental costs and still be much, much better off over time. So leverage is the key driver of what makes property a really great investment. Both have their place. I should just say that we have most of our clients will invest in both shares and property, at different points, and it all sort of comes down to the strategy. I'm going to elaborate on that a little bit more as we go through as well. So leverage is the driver here. You've got to be aware with property, the entry and exit costs are high. You've got the stamp duty in different places around Australia, legal fees, title searches, mortgage fees, mortgage application fees. And then when you sell, real estate agent costs, legal fees again, tax that you need to pay on property as well, depending on how you're buying it. So buying and selling, and it's used to be more common in the past, but people are following these buy, flip property strategies, that all of those costs eat into your return. And when you look at it like in a transparent way, it's you're taking away from your return. So I suppose what I'm getting at is that when we help people buy property, and I suppose what our philosophies are around property is that you want to buy good properties and hold them for the long term, because then you can get the return on a good investment over time and make a whole bunch of money. And you can see from some of those previous examples that the numbers are so big that it's like, why try to push for more? Another thing to be aware of when it comes to buying property is a family guarantee. And for anyone that's not familiar with the family guarantee, so it's got a few different names. That they sometimes call it guarantor, sometimes they call it family pledge. There are a few different labels which can be a little bit confusing, but ultimately what the family guarantee is that when you buy a property, instead of using a deposit or paying your deposit in cash, what the deposit is essentially secured against another property. And where this works is when typically where it works is if mum and dad have a property that it has a low or no mortgage on it, or there's a lot of what they call equity in the property, they can secure your deposit. So if you need a $100,000 deposit, that loan gets secured against the value of their property. Then you get the $100,000. You can use it for the deposit, and then you can then the banks will lend you enough money to go and buy the property outright. So family guarantee, it's a strategy that's not for everybody. It doesn't have to be family. It can be friends, although it's that can be fraught with a bit of danger as well. And I don't know too many people that are wanting to secure their mates' borrowings, but there's no rule around that. It's really just dependent on who you can convince maybe. But it is a great strategy in that it allows you to purchase a property without using any cash at all. And obviously you need to get your numbers right, get your strategy right, make sure you can afford it and be smart when you buy. But it takes a long time to save a property deposit, and we're seeing the market moving at the same time, that you're sort of like chasing your tail, which is, can be difficult, can be frustrating. So using this can help you to get in sooner. The other thing that it does is that it allows you to keep your cash for your emergency fund. And, you want to have an emergency fund even more so when you own property. So even if you've got 50 grand or 100 grand ready to buy property, if you can hold on to that money, park it in your offset account, and have it available, not to spend, but if you have an actual emergency, then that's something that I think can be quite good. Again, be smart, but be aware of the family guarantee. Ask some questions. There's a bunch of stuff online around that as well. Pays, Mother's Day is coming up, guys. Second Sunday in May. Pays to get mum a nice Mother's Day card and a bunch of flowers to give yourself a better chance of having that conversation if you're thinking about it as well. The other thing to be aware of is the difference in buying a property as an investment versus buying as your own home. Now, it's one of the things that I've seen from talking to a lot of people about their money is that they generally people want to buy a property as their own home. People like the idea of buying as their own home. They want to, be able to do the property the way that they want. They don't want to deal with the annoying property manager. And but be aware that there is a significant difference often, and it depends. There's no one better or worse one. It really depends on your situation, tax rates, income, whatever. But there's a significant difference between the financial outcomes of buying a property versus as an investment versus buying a property as your own home. So, like I say, no one right approach, but you should understand the difference and you look at the difference in the numbers so that you're aware of which one is better for you. And then you can think about, because it's not just whichever one's most financially beneficial that's necessarily going to be the right strategy for you, but knowing the numbers means that you can balance the financial side of the equation with the emotional side and what you want and your how you feel about living in your own home versus managing an investment property. Also, understanding where to buy. Look, I talk to a lot of people, and I think that because there's so much noise in the property market, basically all of the time, that people are trying to be really tricky with their property buying. There's always some person that talks about how they made a whole bunch of money over time with their U-Butte sort of property strategy. But the numbers that I showed you before were just on median house price in Sydney. It's broadly applicable to all metro areas across Australia, that you don't need to find the next property hotspot to make a bunch of money. What I tend to find, I think that buying, sticking to the fundamentals and buying a property where there's strong demand, and where there's strong demand is desirable locations, but strong population growth as well, and limited supply. So a lot of the fringe suburbs will have mandates from their councils on how densely populated they can be. Some are more than others. So we see, I know that there are pockets in Sydney where the property density is really high and it's just all apartments everywhere. That just means that there's going to be more supply. And it's not to say that that it's a bad place to buy, but it's just because you've got one side of the equation that there's excessive supply, then it just means that the growth is likely to be slowed with the same amount of demand. So understanding where you should buy, and my personal philosophy is sticking to those, stay away from the actual CBD areas because there's high supply there as well and a lot of apartments and stuff. But and then just look and try and get as close to the city as possible, get as much land as possible. And we've seen all of the properties in those areas grow really well for the last sort of forever. So if you start trying to get too tricky, that's where you can actually shoot yourself in the foot and end up, with a poorly performing or even an average property, which is a real drag on your ability to get ahead financially. I know I've been there myself. I bought this property when I was in uni and never really lost money, but it never made me money, and it never made me much money. But for 5 years, I had this property and I didn't want to sell it, and it was a pain to deal with. And I think that, it holds you back and stops you from buying other properties, which will actually grow. The other thing here is really just balancing your home in the amount of assets that you've got in your home versus the amount of assets that you've got outside of your home. And what I mean by that is that if if you think about your wealth, you've got a whole pool of wealth. You've got, superannuation, you've got cash, any cash savings in your personal name, you've got shares, managed funds, ETFs in your personal name, then you've got property, then you've got debt. That's all in together. But your home, while it's nice to have a nice home in it, and your home is technically an asset, because you always need a roof over your head, your home is not really an asset that's going to give you much financial benefit until you sell it. And then you're just going to have to buy another home anyway. So if you want, say you want an income each year of say $150,000 when you're in the future, when you're not relying on your work. I'm not going to say retirement, but you want to be financially independent essentially. That the rough rule of thumb is you need about 5% from a portfolio of assets. You can get about 5% from a portfolio of assets in an income without eating into capital. So that in human words, what that means is that if you've got $1 million invested in a diversified share portfolio, that you should be able to get an income of about $50,000 each year. And then the implication is if you want 150, then you need about $3 million in assets. Now, if you go out and buy a $2 million home, then if you buy a $2 million home, then you've got a lot of money tied up in this property. You're going to have to pay down $2 million worth of debt, or however much the debt actually is. But then you're going to need to have, essentially like $5 million of assets. So again, there's no one right way, but it's easy to think about the home independent to your other assets. But you need to get the right balance for you and make sure that you're going to have enough other assets to actually give you the financial outcomes that you want, not just a nice roof over your head. What you should be thinking about is looking at the pathway forward, making sure that you can afford the property at the level that you want, pay down the debt, and build enough assets outside of that property, investments, shares, other investment properties, whatever, to allow you to give the life, to have the amount of money that you want to have the lifestyle that you want in the future. And yeah, be aware that there can be stepping stones to your dream home as well. Like property is expensive in Australia. So, if you need to do some things to get to where you ultimately want to be, buying smaller properties, buying properties maybe in a different state sometimes, making sure you're getting good properties, but having those building blocks to get there can make it easier. If you keep trying to gun to your dream home from the start, like I say, if the property market's running away from you, then you're sort of chasing your tail. And one way for you to think about it that not a lot of people do is that if you want to own a $2 million home in the future, if you were to say buy a $1 million investment property today, it's almost like you're halfway there, because it's likely that the $1 million property is going to go up at the same rate, probably, as, or ish maybe, but at the same rate as the $2 million property, it's just going to be half of the value. So if you could buy, the $1 million property halfway there, then you might bolt on another property in the future. And then when you get to the point where you've got enough property, you may choose to sell the properties that you have, or there may be other ways that you can leverage to get into the property at that time. But ultimately, you're sort of hedging your exposure into the property market along the way. So some strategies to be aware of when it comes to property investing. First one is negative gearing, and negative gearing is just borrowing to invest. So borrowing to invest. For any guys watching on as well, if anyone's got any questions, feel free to just pop them into the Q&A as I'm going through, and I'm going to circle back at the end and sort of answer all the questions together. So yeah, negative gearing is just gearing is borrowing to invest, and then the negative or positive, and you probably heard both those terms, refers to the cash flow of the property. So if the rent is more than all of the expenses, mortgage costs, ongoing cost strata, all of that sort of stuff, then the end result of your property investment is positive, is the cash flow positive. There's going to be more money coming in than going out. That's positively geared, because you're geared to get the property and the cash flow is positive, therefore positively geared. Negative geared is just that there's a negative cash flow of the property. Now, when you have a negatively geared property, you get to claim a deduction for what it costs you. So, if you were to say buy $1 million property and say you're out of pocket by 15 grand a year is about on average what it should be costing you out of pocket, then you're able to claim a tax deduction. And depending on what your tax rate is, if you're in the top marginal tax bracket, 47.5%, you're getting pretty much half of that money back. Even if you only earn if you're owning like 40 grand, you're still into the tax bracket where you're getting a third essentially of your whatever cost you pay back, which means that you're, in that example, if you're paying 15 and you get a third back or 5,000, the end cost to you is only $10,000 a year. And that means your property only needs to grow at more than $10,000 a year for you to be better off in doing that. So I know that I'm sort of banding a lot of numbers around there, but this negative gearing is a real kicker when it comes to buying property, and it can help massively reduce the ongoing cost to you after you do your tax return. Deductions, and making sure you get some good deductions from property is one thing as well. There are some strategies where if you buy a new property, you can claim things like depreciation, which is actually the reduction in the value of the fittings of your property. You buy an oven day one, it's worth a couple of grand. As soon as you cook a roast chicken in there, it's worth a bit less than that. That difference doesn't actually cost you money, but it is something that you can claim as a tax deduction when it comes to depreciation. So that can even tip the scales to make new properties positive. Be aware when you buy new properties though, not a real big advocate of buying off the plan because it comes with a lot of risk, but I'm going to talk to that when I get into the mistakes and risk section in a minute. Understanding the difference in offset versus redraw is something that you should really be across as well. The people you buy a property, think you're doing the right thing, trying to pay down your debt, and working towards, we think we should be getting debt free, and being debt free is good. But how an offset account works is it's a bank account that's just sits next to your mortgage, where every dollar that you put in, it offsets you only pay interest on the net amount between the mortgage account and the the offset account. If you build up, say you buy a property, and a common strategy is you buy a property, you're saving up for your next property or for your dream home, and you might save like 100 grand or something like that in your offset. If you take it out and use it to buy a property, no problem there. Your debt always remained at the level that it initially was, so you're able to claim the tax deductions relating to that debt because this property is now an investment property. With a redraw, though, on the other hand, you're actually paying down the debt directly. And if you pay $100,000 of your mortgage down and then redraw it to buy your own home or your dream home, and then you want to keep that property and use it as an investment property, you're no longer allowed to claim a tax deduction for the interest on that portion of the loan, because the purpose of you doing the redraw was not to buy an investment property, but to buy your own home. So I've seen a lot of people that have run into a heap of trouble with, well, not a heap of trouble with this, but just end up in a situation where they're out of pocket by tens of thousands of dollars a year, all from trying to do the right thing, but to not understanding the rules well enough to make it the optimum strategy for them. So this stuff is pretty complex. It's worth chatting through with your mortgage broker or financial planner if you're going to go down this path. But ultimately, there is a big difference, and you should be aware of that difference and its impact. Debt recycling is another strategy that I'm seeing a bit more of these days. It's where it works for people that own their own home, that have a mortgage on that home and that want to invest. And essentially what it means is that, say if you got in the simple terms, you've got $10,000 in cash, you pay that onto your mortgage, you pay the mortgage down, so your mortgage reduces by 10 grand. And at the same time, you draw from another debtor that you need to get the right mortgage structures with this, but essentially like a line of credit at the same mortgage rate as your property purchase. And then you invest that $10,000. When you do that, you end up getting a tax deduction because you're borrowing to invest, then essentially you're taking that $10,000 out to invest into your share portfolio. That the interest on that debt is now deductible. And because the interest on your own home is not deductible, how debt recycling works is that over time you reduce down your non-deductible debt, and then you're drawing up your tax deductible debt, and it can save you in the tens of thousands of dollars a year. It also works if you get a big chunk of money, you can do it all at once, which I've seen some people do before as well. So huge tax dollars to be saved there. Again, it is complex, so make sure you're getting the right advice. The right advice will more than pay for itself, though, if that's an avenue that's available to you. Some of the mistakes that I see people make. Look, the first thing that, and this is a really big one, is that you don't always understand. One of the things that stops people from investing and buying property in particular is that you don't always understand where the risk is coming from. And if you don't understand where your risk is coming from, then it's almost impossible to manage your risk. And then it's really scary to invest, and it's paralyzing. So the key to understanding then managing the risk at a level that you need to take confident action is you've got to identify where the risks are coming from, see how you can manage them. There's always some risk left over, because risk is what makes you money. Buying shares is risky, buying property is risky, doing nothing has risk attached to it as well. So identify those risks, understand the trade-offs, figure out what the right risks are for you, and then you'll be set to get the right level of results and have your peace of mind along the way. Lifestyle risk is a big one with property, and I've seen some people that have really sort of come into some trouble here by not thinking ahead beyond that. They think about whether they can afford the property today, but they don't think about how that property fits in with the lifestyle that they want to have over time. That doesn't fit in with the so I suppose that the other things that they want to do, a common one is like taking time out of the workforce for having children, or schooling costs. Daycare is really expensive. Schooling, if you want to use private schools and stuff, you need to, if you want to have the ability to do all of those things, you need to make sure that if you're buying this big property at the start, that's going to be consistent with the other things that you want to do. So take the time to map that one out, and you can avoid the lifestyle risk. But because if you don't, then you can end up in a position where you're having to either sacrifice some of the stuff that you want to do or sell your property and go backwards, which is not an ideal scenario either. Making your choices in isolation is another big mistake that I see people make as well, which is, people look at a property just as an investment. It happens with all areas of money, not just property. But if you look at a property, is this property a good property? It might be a great property, but it might not be a great property for you for any number of reasons, not least of which the stuff that I just talked about with the lifestyle risk. So when you're buying property, you want to look at property as part of your overall strategy, and make sure that it's not only good in absolute terms, but it's going to be at the right level to deliver you the results that you want. Seeking the best option is another thing that sort of paralyzes people, where, I see this typically from your engineers and more analytical people, where you're crunching your numbers in spreadsheets, looking at which yield is better versus growth rates versus population growth, like all of these things, and trying to find the very best thing. But no one knows what the best thing is until after the fact. So settling for something that's good and taking action now will mean that you can start getting results, rather than trying to find this mythical best option that we won't know until what it is for 10 years anyway, and by then you would have missed the boat. Unconscious prioritization is something as well that people, and it's sort of, I suppose it's more with your strategy side than with the property selection side, but we're always prioritizing with our money. We prioritize with how we spend on a day-to-day basis and how we invest longer term. Now, what we've found is that because we're all pleasure-seeking human beings, and spending money, like going on a bit of a spending spree now, or buying that new toy or holiday, or spending more than you know that you should, is something that makes us feel good in the moment, but something that's bad for us long term. So found that when you make decisions at the 50,000 foot level, you'll set certain priorities, but into the day-to-day, we sometimes act in a way that's inconsistent with those priorities. So you just need to be aware of what your priorities are, start up at the top, and then make sure that all of your decisions and strategy and actions are consistent with the priorities that you've set for yourself. And getting the wrong advice, this is something that's really, it really sort of grinds my gears in the property space. Thankfully, the legislators are looking at this more closely now, although it's still nowhere near where it needs to be. But, property spruikers, selling off the planned properties, borrowing too much money, doing the wrong things, or, you see a financial planner that isn't across property, and they're convincing you that you don't